and I'm going to be explaining weekly time frame market structure and also how to use that in your trading. This is going to help your understanding of overall market direction. So from the monthly in the previous sessions, this was the monthly swing low and swing high as well. And you can see that on the weekly time frame. This is our swing low, our swing high. Now this is the range that we're working with on the monthly time frame. And you can see that as well on the weekly, we're still working with the same range, swing low, swing high. And you can see here very much clearer. Like I said in the previous session, the market was hunting for liquidity because anyone who was on a buy would have moved their stop loss right here. And you can see this low and this low. This is also liquidity. If this low right here had taken liquidity from this low and rallied, I would have felt like it's a strong low. But whenever I see lows like this, I regard it as a low resistance liquidity. You can see we made this first low right here, failed to take the other low, and then rallied. I see this as a low resistance liquidity, and price can easily come back to run such lows. You can see that right here as well. You can see how price came down and ran all those lows that are like this. And a lot of traders, this was why I said that when you learn trend lines, it's good, it's amazing, because now you can use that to understand why you've actually been the liquidity in the market. So far you can see that right here. That's a trend line, and you can see how price came there 1 2 3 4 5. So traders were anticipating for this to hit it again and then continue higher, but you can see how price just dropped drastically. So the moment you start seeing things like this, you already know how to draw a trend line. You can draw the trend line, but now you're anticipating for price to run these lows because they are the liquidity. And you can see how we ran that low, every single one of them, because they were the liquidity. And now, so far you can see after seeing that liquidity run on the weekly, we'll focus on the structure. Now, after we made the swing low and the swing high, we came down here, grab liquidity, and you can see the structure that we were forming so far right here. This high, so this high, and then we created this low, and then this high right here, we created this low. So we were making lower highs and lower lows, lower highs and lower lows on the weekly time frame. Remember, overall on the monthly, we were bullish. We were bullish overall on the monthly. Now, on the weekly, price was trending to the downside, making these lower highs and these lower lows. And then suddenly, we saw this. We saw this right here. This is a high, this is a low. We ran above this high, showing that the market structure on the weekly, which was bearish, switched to bullish, aligning with the monthly. So you see that the monthly and the weekly aligned right here to bullish. So regardless of price coming down, I'm still going to have that at the back of my mind, because these are what controls the direction of the market. The monthly and the weekly are the ones controlling where they want it to go. We want it to go to the upside, it's going to the upside. We want it to go to the downside, it's going to the downside. And we don't try to trade against these two time frames, because you can see shift in market structure in the 4-hour time frame, and price could just shift and show you shift the market structure, make you think that it's just going to drop and go to hell, and then you suddenly see something from the weekly or monthly reject price places like this. This is a monthly time frame point of interest, and we have showed you how to annotate this point of interest from monthly and weekly. Then you go down. After that, we're going to scale down into the smaller time frame in other sessions. So I'm going to end this here, and then the next session I'm going to throw more light on this. Talk to you in the next session.